Visa is the most obvious stock to buy now in the market. We're going to run through exactly why that is, looking at the historical performance of this company, looking at their phenomenal income statement, their top line revenue, as well as their bottom line net income growth with their latest earnings. We're going to look at the health of this extraordinary company, their total cash versus their total debt. We're also going to see how they've performed in the industry as a whole, year to date as well as the last 5 years. We'll always take a quick sneak peek of the institutions, whether they are buying or selling. We'll also look at their financial metrics as well as that dividend safety, as well as touching upon some very, very big news for this company that was released with their earnings. And as always, we will run them through our valuation model, getting to what we believe their intrinsic value and acceptable buy to be with our margin of safety. Now, this company has been on a phenomenal run year to date, up 24%. We do see it at its 52-week high, but do bear in mind 52-week high is never a sign of overvaluation, and the current yield sits at around 0.81%. Now, looking at the last 10 years, this company has been up 408%, and it is positive to see it is going in the upward trajectory. And even though it does dip, it does continue to drive forwards, as we can see here. Now, in terms of the income statement, what we like about this, well, typically we like to see 3 to 7% growth year on year on the top line. September 2019, 23 billion reported. September 2023, so their latest annual accounts for this year, 33 billion. So very nice growth over the last 5 years. In fact, 50% increase over that period, so that is positive. On a more granular level though, we do see a decrease to 2020 and then it does pick up, but you could argue with COVID that is a fair enough explanation, and over the last 5 years the growth has been very strong, so very positive to see. Now, the bottom line, how does that essentially consider? Well, 12 billion in September 2019, 17 billion in 23. So again, very nice to see almost 50% growth on the bottom line as well. And it is in line with the top line with a decrease to 2020 before picking up every single year after. So very strong income statement in my opinion based on that 5-year growth. And now when we look at their total cash versus total debt for a quick health check, 12 billion in September 2019. Latest quarterly report, 20 billion. So again, even their total cash position and short-term investments has increased quite significantly over the last 5 years. And that 20 billion of cash, when we compare it numerically and directionally to total debt, we see it move from around 16.7 billion to around 21 billion. So yes, their total debt has also increased, but it is roughly in line with their cash position. So they hold roughly the same amount of cash that they do total debt, which is always a positive sign. Now, quickly comparing them on a total return basis versus some well-known competitors in the transaction and payment processing services, we have MasterCard, Fiserv and PayPal. Now, year to date, remember this does include those dividends reinvested. Visa is the second best performing, up 25%. We do see Fiserv up 29%, so slightly higher. And when we look at the last 5 years, we see Visa up 83%. Now, we can see it is there in the top 3, lagging, however, behind MasterCard, but that is still very strong over the last 5 years. Very positive to see. Now, in terms of institutions, we see 81% institutional ownership, 40 billion of sales over the last 12 months, but around 500 billion of buys in the same period, with the biggest buy coming in Q2, around 484 billion with 25 billion of sales. So very positive to see. Institutions are buying this company, but we also can see there is relatively little movement along the other quarters over the last few years. And as always, we also need to do our own due diligence and buy based on our own investment thesis. Now, before we jump into their dividend safety and their financial metrics, let's take a quick look at their earnings. And I just want to highlight that over the last 4 quarters, they have beat both on the top side as well as the earnings per share. We see here a double beat in Q3, a double beat in Q2, and a double beat in Q1 of 2023. And if we want to go into Q4 of 2022, they also beat as well. So this is a company that continues to beat analyst estimates. And when we compare Q3 23 versus Q3 22, an increase to the top line, an increase to the bottom line, an increase to the earnings per share, as well as the bottom line margin and operating income. So not only are they beating analyst estimates, which is good, but also even better in my opinion is when they beat prior years, because sometimes you don't realize, but analysts, when they do have their estimations, it isn't always higher than the previous year. So for me, this is a lot of useful information and it is very positive to see. Now, just before I do jump into this, I just want to highlight something that I consider to be very, very strong for any company. Visa announced that they are doing buybacks of around 25 billion worth of shares, which is very positive to see. We will analyze the metrics and we will see that this company does a lot of buybacks, but this, on top of their high dividend increases that we'll touch upon now, is phenomenal from any company. There are a lot of people that will be saying this company is at an all-time high, it's too expensive, but let's take a look at the data and see what it tells us. Dividend safety score 99, it is very safe. Market cap 515 billion, so it is a mega cap company. And when we look at recessionary metrics, yes, they did increase the dividend during the 07-09 recession, and they had positive 10% sales, which was well above the average growth of companies in the S&P, which was negative. Latest increase this year, 16%. Latest or increase over the last 5 years on average, 16%. Last 10 years, 18%. Let me know if you've been getting in your dividends, your salary, or other income producing assets an increase over the last 10 years of 18% on average, because that is absolutely phenomenal. It is one reason why I do consider being a dividend growth investor as one of the best ways to accumulate wealth, and they have been increasing those dividends over the last 15 years. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. So we have a sign here, 0.81% versus 0.67. But remember, we never look at any of these models in isolation and draw our conclusions towards the end. Forward PE at 25.9, also below the 5-year average of 29.2. When we do, however, compare it to the financials, sector PE at 11, it is significantly higher. Now, as mentioned, just because a company is at the 52-week high, it doesn't necessarily mean it is overvalued. As always, we ditch the earnings payout is susceptible to manipulation by management through accounting. Free cash flow below 60% is what I look for. It does give me faith that management, if they want to, can offer those double-digit increases. Now, it is roughly below 20% consistently over the large period of the last 10 years. 2023 at 19%, very nice to see. 2024 expected to be around 20-21%. So again, this is a company that is not only increasing those dividends by double digits, but also look how much of their free cash flow is being paid out. It is very minimal, so this is incredible to see. Free cash flow per share is also increasing, 266 in 2014, 962 in 23, and is expected to go even higher in 2024 to just below $10. Now, when we take a look at the sales growth, 3 to 7% as a minimum, well, they hit nearly double digits every single year. Personally, I can justify that negative 5% due to COVID, so for me, that isn't a worry. And they've rebounded nicely in 2021. And with 11% increase on the prior year, it is well above that 4% or 3 to 4% inflation target as well. So lots and lots of positives. And let's start off with another positive here. Shares outstanding. We saw 2.52 billion worth of shares in 2014. 2.09 billion in 2023, and they are planning to do more share buybacks. So realistically, what more could you want from any type of company that you're invested in? And numerically, for those that like to see how the top line has moved, well, nearly 3 times from 13 billion to 33 billion in 2023. Now, when we take a look at the ROIC, 10% or more, remember that is our target due to the fact that we want management to allocate their capital effectively. I mean, double digits every single year, and we're talking very strong, 31% in 2022, 34% in 2023. Now, free cash flow margin, operating margin, I've said this so many times, this company is phenomenal. They have very high operating margins, which means in theory their bottom line, net income should be very high, and therefore those dividend increases that we come to love for this company. And free cash flow margin, they are a free cash flow machine. Now, when we take a look at the net debt to EBITDA, so for those that don't know, earnings before interest, tax, depreciation, amortization, this is essentially showing us how many years it would take the company to pay off all of their debt net of cash on hand. 2023, it would take them 0.05 of a year to pay it all off. So they have a phenomenal balance sheet, as we did analyze. So that is the Visa company. Now we can jump straight into their valuation. And as always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe and bell so these videos drop as soon as we are delivering them. And if you do want to grab a copy of the valuation model we're about to run through to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Now, typically, Graham's valuation would be the first model that we're using. However, given the rapid increase in Visa, they are a fast-growing company. This isn't relevant, but for those that want to see the number or how it works, we have their stock ticker symbol, the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds to give an intrinsic value. Bear in mind, the higher the yield, the lower the intrinsic value. We then jump into the first model that we're using, the multiples valuation model, companies in a similar sector and size. We looked at these on the 5-year total return. MasterCard, Pfizer, we have their stock price, earnings per share, their PE multiple, get the average, multiply by the EPS of Visa, to get a stock price of $263. Now, when we take a look at that, we can see there is some slight upside to the current trading price, so you could argue reasonable / slight undervaluation based on the multiples valuation model, but do bear in mind we're not looking at any of these models in isolation and drawing our conclusions towards the end. We then have the DDM model where we have the yearly dividends, phenomenal growth over the last few years. Average 16%, we have gone 7.25 forward looking. As always, if you do want to play around with the percentages, go higher or lower depending on your investment thesis, do click on that pinned comment below and grab a copy. So the DDM comes to 297. Now we're looking at some very nice undervaluation in the current market and above the 52-week high, which is essentially that current trading price. We then move on to the third model we're using today, the discounted cash flow model, my favorite model with the free cash flows year on year. We have the average growth rate. Now with the growth rate forward looking, we have gone slightly lower than analyst estimates to be more conservative. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to give a DCF price of $312. Now, when we take a look at that, that is some significant upside still to the current trading price. And I know a lot of people will be saying it's at an all-time high, it's not going to go higher. There are many examples of companies that have been at all-time highs and have gone even higher that we can run through if you do want to be analysed. So a lot of upside based on the DCF model. And as you can see, we have gone, in my opinion, for quite a conservative forward-looking estimate at 8%, as we see the last 2 years significantly higher. Now, in terms of the intrinsic value for today's episode, it's the average of the 3 models. For reasons mentioned, we're excluding Graham's valuation. So it comes to $291. Now, with the current price at $256, margin of safety. Now, this is where I would say we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Personally, I would argue that with Visa, it does meet all of those, and you could happily buy this at a 10% margin of safety, and that would be up to $262. Now, those looking at a 15% margin of safety would be looking around $247. So right now, you are getting between a 10 to 15% margin of safety on Visa. Now, in terms of Wall Street, what do they say? Well, they believe the share price has some nice room to grow, around $25 per share, slightly lower than our intrinsic value. Do let me know your thoughts in the comments. Do you also believe that Visa is undervalued? Is it one that you have been buying, or one that you are considering buying if it reaches a certain price point? As always, if you do want to grab a copy of the valuation model, whether to run your own companies through, companies on your watch list, or just to run through these Visa analytics again based on your own estimations, do click on that pinned comment below. If you want to join us in the Discord talking all buys and sells in the stock market, again, click on that pinned Patreon link below. And finally, let me know your comments below. Hit the like button if you've enjoyed today's episode. Subscribe and hit the bell if you want to be continually notified of these videos as they drop. And as always, just have a great day and catch you on the next episode, and take care.